So tonight, we are going to be looking at interpretation of financial statements. That's what we're going to look at tonight. And when it comes to interpretation of financial statements, for your exams, two major items, or let me call it, there are two major tools for interpretation that are usually available for any analysts, in your case, students, for your exam. One is ratio analysis. Ratios is a tool that is used for interpreting financial statements. Another powerful tool is a statement of cash flows, is another tool that is popularly used to analyze financial statements. So we'll try to see if you can have a good idea of how to use this tool. Tonight, focus is going to be on ratio analysis. And I'm going to use a past question approach, meaning we're going to use past questions to really tackle this topic so that we can use a stone to kill two birds. And we're looking at last diet question. And ratio for the past 5 or thereabouts, 5 diets, back to back, you get ratio as question 2 for 20 marks. And it's usually under section B of your exam. Looking at this question, in your exam, the first place you should always go to when you are faced with any question, when you are in the exam hall, is to go and read the requirements of the question. Even before you read the question itself, go through the requirement first. And from here, this question says you are required to prepare a report analyzing the financial performance of Agrocom Nigeria Limited and its financial position for the year ended June 30th, 2020, for 12 marks. The B part says, advise Alhaji Kyari, the chairman of your company, whether your company should consider these investments. C, we're asked to forecast year 2024 profit for the retail operations using the business outlook. You will see that the A part really talks about you preparing a report, analyzing performance and position. And if you check the previous diets, it's always like this. And they'll ask you to advise. So my focus for tonight, majorly, is not even in how to calculate ratios, because the bulk of the mark in these 12 marks, you will derive it from that analysis. Of course, before you can analyze, you must compute those ratios first. Now, having understood the requirement of this question, which is to prepare a report analyzing performance and position of Agrocom, we're asked to advise the chairman of our company whether our company should consider this investment, and they ask us to prepare a forecast. So we can then go ahead and read this question. He said, the following is the financial information extracts of Agrocom Nigeria Limited. We're given the P&L for 2 years. We're also given the statement of financial position for 2 years. They gave us the revenue and profit of Agrocom Nigeria Limited, 3 business segments for the year ended June 30th, 2023. We're given the retail operations, online stores, and SOCH contracts. They give us the revenue, the gross profit, and the PBT. So they give us some background information. Number one, it says Agrocom Nigeria Limited has been trading for more than 10 years, producing and selling children toys to the public in its 15 retail shops and other retailing customers. They also said Agrocom Nigeria Limited revenue and profits have been very stable over the last 10 years. However, about 1.5 years ago, a newly appointed sales director saw an opportunity to sell the products online. The company, using long-term funding, then set up an online shop. The online shop has been operating very well for the last 40 months. Sales director also used his personal connections to secure lucrative deals with Save Our Children Home across the country to supply customized children toys. Contract was signed on January 1st, 2023. The managing director of Agrocom Limited is of the opinion that more market can still be explored with the online markets and contracts with SOCH. However, their bankers are not willing to grant further long-term loans and overdrafts because the company has insufficient assets to offer security. The existing funding is secured on Agrocom's Nigeria Limited's property, plant, and equipment. The managing director of Agrocom Nigeria Limited has therefore approached a wealthy personal investor, Alhaji Kyari, the chairman of Jolimag Investments Co. Limited, for financial assistance for Agrocom Nigeria Limited. The business outlook for retail operations for next year is as follows. A, due to improved patronage, credit sales, which is made up of 70% of current sales, is expected to increase by 20%, and the remaining cash sales by 10%. All related costs of sales are expected to increase by 12%. Related bad debt written off is expected to be 10% of credit sales. As the accountant or chief analyst of Jonima Co. Limited, you are required to do this. Okay. So they are seeing you as the accountant or chief accountant of Jolimag. Remember that your chairman happened to be the last resort of a company called Agrocom. They need money. And Alhaji Kyari, who is the chairman of Jolimag, is considering a potential investment in Agrocom. And you work with Alhaji Kyari, you work with Jolimag, So you're supposed to analyze the performance and position of Agrocom. And when it comes to analysis, you have to use ratios. So how do you approach a question like this to ensure you maximize your mark? It's 20 marks. So in the exam, the first thing you need to identify is that this 20 marks translates to around 36 minutes, because by the time you multiply the mark by 1.8, it gives you the number of minutes you're expected to spend on this question in the exam, so around 36 minutes. And I can see these 12 marks, 4 marks, 4 marks. And these 12 marks requires you to compute ratios and also, of course, analyze it with a report, because you will have to write a report. So they gave me P&L of this company, of Varocom, and I was given the statement of financial position of Varocom as well. And they gave me information on some segments. Now, you see, when you want to analyze ratios, the question always comes in this format for you, because they will give you some context around what is happening with the company. In this case now, this company called Agrocom, they have been operating for 10 years. They sell toys. And from note 1 and note 2, they are giving us the impression that the company is stable. They have been stable for the last 10 years. They have stable revenue, stable profit. But the third point is showing us that they diversify into online shops, and they used loans, long-term funding, to do this. And also, they also got a lucrative contract, Save Our Children Home deal, where they can supply customized children toys across the country. So that means they are doing very well. Now they need more money. They went to the bank. The bank refused them, saying that they have insufficient assets, that their existing funding is already secured on their existing PPE. So they said they can't give them additional funds. And that's why they approached the chairman of your company, Alhaji Kyari, who is the chairman of Jolimark Investment Co. And you are supposed to be advising Alhaji Kyari whether I should invest in Agrocom or not. Now, in the exam, when it comes to analysis, the first thing is to go to your workings. And you don't have to leave space. Don't be leaving space that, okay, you want to leave space for, the report. Just start with your workings. And when I say your workings, I mean your ratios. Just start computing your ratios. Now, what ratios are we looking at? The requirement of the question says, analyze the performance and position of this company, of Agrocom. Now, for financial performance, the relevant ratios will be profitability ratios and efficiency ratios. For financial position, the relevant ratios will be liquidity ratios and solvency ratios. Since you have 12 marks, at least you should be able to compute around 4 times 4, around 15 ratios in all, between 12 and 15 ratios, worst case. So this will afford me the opportunity to show you all the ratios, show you how to compute it. So solving this question is the logical thing to do. So let me start with the profitability ratios. Please, I will need you to bring out your calculator, because cannot be solving and be the one calculating it also. We need to participate. The most important profitability ratio is return on capital employed. Return on capital employed. And return on capital employed is simply my profits. Let's use profit before interest and tax. Interest and tax divided by capital employed multiplied by 100/1. They want us to compute for 2 years because we have 2 years reports, 23 and 22. So we have to compute for 2023 and 2022. Now, you see this ratio, return on capital employed, from the name, return on capital employed. This ratio measures the amount of profits that an entity makes on the capital invested. It measures the amount of profits that an entity makes on the capital invested by the owners of the business. And it's simply profits before tax over capital employed. This capital employed would be equity plus debts. And the debt in question would be fixed interest debts, meaning interest that you pay, debt that you pay interest on. Those are the relevant debts here, the ones you pay interest on. That's your capital employed, your equity plus your fixed interest debt. And it makes sense to use capital employed as equity and fixed interest debts because this PBIT is a profit that belongs to both the equity holders and the debt holders, because this is PBIT, profit before interest and tax. You know that it's also possible that this ratio can be PAT, or your profit for the year, divided by capital employed. If you decide to use profit for the year divided by capital employed, you are also correct. You are correct. But in that wise, if you are using profit for the year, the capital employed you must use should be your equity alone. Because if you are using this profit up here as profit for the year, profit for the year means profit after you have deducted all expenses, after you have paid interest, you have paid everybody. It is a profit that belongs to the equity holders. If you are using profit for the year, your capital employed should simply be equity. But if you are using PBIT, your capital employed should be equity plus fixed interest debt. In 2023, what is our PBIT in 2023? We'll go to our P&L. This is our P&L. In 2023, what should be our PBIT? Anybody? What should be our PBIT?
Two, three, three, two.
Let me know the people that want to participate so I can relate to those people. Some people might be on the road or something like that. So they might not be participating.
2023 is 2332.
How did you get that? For 2020 what?
2023.
Is that
2332.
2332?
2332.
Okay, how did you get that?
I did a profit before tax plus finance cost.
Okay, that's correct. So 2160 plus 172. Okay. So in 2023, we're looking at the PBIT is 2160 plus what?
172.
172. Okay, what about in 2022?
I didn't get the figure. So.
That would be 1222 plus 136, Abby? 1228 plus 136
1364.
plus 1. Okay.
138. Okay,
Divided
138.
by capital employed, Abby?
Yes, sir.
And since we are using PBIT, our capital employed will be equity plus debt. So our total equity in 2023 is 5088. Can you all see it? That's my total equity in 20.
Yes.
And my fixed interest debt, which is these loan notes, is 1648. So I will come for 2023, which is 5088 plus 1648. Sushidima, you have this in your mind, 4640 plus 1616. When I get out, I'll
Wait,
ask.
hold
So
on.
this 50881648, 5088 plus 1648. Hey, Shidima, tell me, what's the one of 2022?
For 2022 is 4640. 4640 plus 1616.
16.
4640 plus 1616.
Okay. So that is our capital employed. So of course, multiply it by 100 times 100, and this one times 100. So let's get the figures. So in 2023, just give me the final answer. That's how much in percentage.
%.
For 2023,
Yes,
what
sir.
am I 20?
22%.
Okay, so that's the first ratio. Second ratio you can compute is your net profit margin. Net profit margin. Can anyone tell me the formula for net profit margin? Net profit margin. You can use profit for the year divided by your revenue or your sales multiply by what? Multiply by 100. And what this ratio measures, it measures the amount of net profits, the amount of profits that is made on every sales, the amount of profits that is made on every sales. That is what your net profit margin, that's what it measures. So our profit for the year in 2023 is 1620, and in 2022 is 902. While our revenue in 2023 is 24,000, and in 2023 is 14,800. So I'm going to cram the profit 1620 and 908. Chidima, cram this profit 2023 and 2022. Okay.
Hold on, sir. Please let me snap it. Okay, I'm good. Okay, sir.
Okay.
Okay.
What's the profit of
The revenue.
2023?
Revenue is 24,000. 24,000. Revenue
How about
24,000.
2022?
14,800.
1,100.
So what's the margin?
7% for 2023.
2022?
6%.
6%. So Chidima, which one do you think is better? Is it 2022 or 2023?
2023, though, is the marginal growth. No, it's 2023.
Okay. So what does this 7% means now?
That for every unit sold, I don't even remember how to put it. For every unit sold, that they made a 7% of 7% profit out of every sales made.
That's correct. That's fantastic. Let's do operating profit margin. This is very similar to net profit margin, but in this case, we are using PBIT, your profit before interest and tax, times 100, divided by your sales. So I don't have to go up. My PBIT is up here. Can simply use this. Why for 2022? Can use this. And my sales, here is
24,000.
24,000. And here is how much?
14,800.
14,800.
Okay, so how much are we looking at?
2023, sir, 10%.
10%?
Yes, sir.
How about 2022?
9%.
Also a marginal difference. So the interpretation is almost the same. This company makes 10% operating profit on every sales. Another profitability ratio will be your gross profit margin. And this simply is gross profits times 100 divided by what?
Sales.
Divided by sales. So what's my gross profit?
7,668 for 2023.
7,668 for 2023. What about 2020?
4,440. 3,440.
Okay. The sales
24,000.
sales is how much?
24,000 for 2023. $24,000.
24,000. How about 2022?
14,800.
So what's the ratio?
32% for 2023.
About 2022?
30%.
30%. Okay. So that's all my ratio for 4 is okay for your exams. Coming, there's something on my screen. Okay, so for your exam, you can just compute this 4. You are fine. But aside this, do you know any other profitability ratios aside this 4? Any other profitability ratio? I think there's a ratio called cost of sales ratio. I have to compute this. There is a similar ratio called return on equity, but this one is very similar to return on capital employed. Somebody said return on assets. That is also the same thing as return on capital employed. So I will not really advise this one in the exam. Even this cost of sales ratio, do you know that is simply your cost of sales? Your cost of sales divided by sales. Of course, multiply by 100/1. And it measures the amount of cost of sales incurred on every sales in such a way that if your cost of sales ratio is 20%, meaning on every sales, you incurred 20%, Do you know that your gross profit margin will be 80%? If your cost of sales ratio is 20%, which means that you incur 20% cost of sales on every sales. That means your gross profit margin is 80%. But gross profit margin is gross profit over sales. Another profitability ratio could be expense to total expense ratio. This is not so. So it could give you a particular expense on the total expense. I've seen a ratio the examiner called gross profit to capital employed. Okay, which is the amount of gross profit made on capital invested. And you can do operating profits, which is PBIT, to capital employed. So there are quite a number of them. But for your exams, because you have 12 marks and you need to compute like 15 ratios, because they ask you to analyze financial performance and financial position. So you need to compute profitability ratios, efficiency ratios, liquidity ratios, solvency ratios. So you really don't have more time, and you have to be very, very efficient in your calculations for your exam. So 4 is just fine for you. So I have 4 profitability ratios. Now let's do efficiency ratios. You know, these efficiency ratios, majorly they look at majorly working capital management, how well an entity manages its working capital, or how effective does an entity uses its assets to either generate sales or profit. How effective? And the first one I will give you is asset turnover. This is very similar to facts. This ratio is close to profitability ratio. It's close to profitability ratio. Some people see it as a secondary ratio to ROCE. And what this ratio asset turnover looks at, it measures the number of times an entity is able to convert its assets to sales. And that's why the formula is sales divided by total assets. The number of times an entity is able to convert its total assets to sales. And in some questions in the exam, they can call this net asset turnover. When they call it net asset turnover, that means your denominator here will not be total assets. It simply becomes net assets, which is most likely your total assets minus your liabilities, or you can simply use your equity. So in 2023, my revenue is 24,000. And in 2022, I think it should be 14,800. Let's go and check our total assets in 2023 and 2022. Okay. My total asset in 2023 is 8460. 2022 is 7768. So 8460, 7768. So do the math. How many times?
4 times.
2 times or 4?
Three times.
3
2.8.
times. Okay. What about 2023?
2 times.
So this company is able to convert its assets to sales 3 times in 2023. That's efficient. Another ratio is trade receivables collection period. Trade receivable collection period. And it's simply trade receivables was multiplied by 365 days divided by credit sales. I've seen students make mistake of doing a reciprocal for this formula, doing credit sales over trade receivables. Because that'll be wrong. It's trade receivables over credit sales. And this ratio simply measures the number of days it takes to collect our money from our customers. The number of days it takes to collect our money from our customers. And if you go to the question in 2023, what's our receivables? 1820 in 2023. And in 2022 is 1240. So 1820 and 1240. Plus multiply by 365. Multiply by 365. Divided by credit sales. The credit sales will simply be your total sales, which is 24,000, 14,800. So how many days are we looking at?
28 days.
How about in 2022?
That's 1 days.
Which one is better, 2022 or 2023?
2023.
Okay.
They have a shorter collection period.
Yes. We also have trade payables payment period. Which is our trade payables, of course, times 365 days divided by credit purchases. In most questions, you will not find credit purchases. You can simply use your cost of sales for these credit purchases. So let's go to the question and get our trade payables. Okay. 1452 and 1512. 1452, 1512. Now let's get our cost of sales.
16,332.
What's our cost of sales?
16,332.
Okay. 16,332 in 2023. How about in 2022? How much?
10,360. 10,360.
Okay. So how many days?
32 days for 2023.
How about 2022?
1512. 53 days.
50.
3. 53 days.
Okay. So here now, which one is better?
2022.
2022.
2022.
Yeah.
So you think that the longer the better? Why?
The money they should have used to pay the people they are owing, they could use it for other things, help generate more profits for the company, and then pay back later if they have good credit terms with their suppliers.
Well, I don't agree with that. That's not very practical. I mean, it's just like you're saying, let's say you sell fans as a business. That's what you do. You sell fan. You now sue the fan. You will have the money. You now kept the money. You did not go and buy another fan. You just kept it. And you're now using the money to do something else. You did not go and pay your supplier so that he can give you another fan to sell. You now keep the money and say you want to use it to make money in some ways. Why not just leave the business of fan and go and be doing the business of investment banking, where you can be managing idle funds? Yeah. So I don't know. I hear that analysis a lot from my students, and I think that analysis is not correct. Don't use that line in the exam. That when an entity is having an extended payment period is good because they can use that money for something else. No, no, that is not it. You see, a company that is having an extended credit period might be good if we know that that extended was given to him by his supplier. If it is supplier that approved that extended credit period, then that is good. Also, provided that when you look at his profitability ratios, this guy, to a large extent, his profitability ratio looks okay. It's a strong company. It's profitable. Even though the net profit margin seems small, the operating profit margin also is okay. This company is doing not so bad. So, I mean, for now, and is a little efficient, we can say it's a strong company and is doing very well in sales. So, which might explain why he has 32 days from his suppliers. Why is taking him 32 days? Because probably maybe the supplier allowed him to do that. We can justify an extended credit period from that standpoint. Now, this is decreasing. In this case, is decreasing. A decreasing payables period is not also bad because it could indicate that you are selling your inventory very fast and you're paying your suppliers as quickly as possible so that you can get another set of goods and sell. It could indicate that. And it could also indicate in a case of a company that is not so profitable, that is not so liquid, or that has been delaying payment to that supplier, it can indicate that the supplier is not ready to give him additional period. They reduced the number of days they are ready to give to him. That's how to justify a decreasing credit period. So from here now, we can see that this decreasing credit period might be as a result that the turnover is okay, and which is seen from here, it's asset turnover. And I've not computed the inventory turnover ratio. I will have looked at how fast does it take to sell his inventory. So we can see that he's paying his suppliers early enough, which will also improve his credit rating. But if I want to justify an extended period, an extended payment period, if you are taking a long time to pay your supplier, I can say that yes, is a profitable company, and the suppliers allowed him extended period. But if I look at other ratios and I see that like maybe his liquidity ratio is very bad, it's not so good, his profitability ratio is not also good, my analysis for the extended period will be that this company is not liquid and is delaying his suppliers' money to run his business, because there's no any rational reason why you would want it to be your supplier's money you want to use to do some other things. It should be some other money, not the money for your supplier. Which is why I don't want you to use to analyze an extended period by saying you can use that money for something else. No, the last money you want to use for something else is the money that belongs to your supplier. Abi, what do you want to use it for? You want to put it in fixed deposit, or you want to use it to pay salaries or rent, or what? What exactly are we using it for? And remember, supplier give us free credit, trade credit. They don't charge us interest. It's the best form of credit you can get. So we don't want to delay their payments. So it depends. So from here now, this guy is having a decreasing payment period. Okay. So I can say that his profit is a profitable business. He's doing well in asset turnover, and is ready to pay his suppliers as early as possible so that he can continue, so that he can get additional goods and also go ahead to sell those ones as fast as possible as well. So let me even see his inventory turnover period and see how many days it takes to sell. It takes him to sell his inventory turnover period. This is the number of days you hold your inventory before you eventually sell it. You could either use average or closing inventory. Plus, multiply by 365 days divided by cost of sales. So in the exam, I will always advise you to use closing inventory. Don't use opening plus closing divided by 2. You might run into problems. Because if I want to use average inventory in this question now, I will find it challenging, because even though I can get closing inventory for the current year and also opening inventory for the current year, in 2022, I will not find opening inventory. I can only find closing. I will not find opening anywhere. And the reason it's easy for me in 2023, because when you look at inventory of 2022 becomes the open inventory of 2023. Why this 5040 becomes the closing of 2023. But in 2022 now, you have closing, you don't have opening. You will now be looking why you are in the exam. So just use closing. In 2023, 5040. In 2022, 4720. So 5040. And this is what?
4720.
Divided by cost of sales.
16332.
And this one is, so how many days are we looking at?
M360.
Yes. So how many days in 2023?
Let me recalculate. 113 days. 113 days.
How about this?
166.
One
166 days.
for me now,
166.
Abi.
Yes, sir.
So for me now, I think I would find I can justify why its suppliers are not ready to give him an extended period, because 113 days, that's a lot. That's over 3 months to sell. I mean, it's delaying this guy money. That's why they are reducing the credit period they are giving to him. The reduction is because this guy is not ready to extend him credit. Because in this first year, it took him 166 days to sell. That means he will have delayed this guy's money, which is why he says, "Oga, I can't do," which is why he himself will try as much as possible to pay within 32 days. Okay, these four ratios is sufficient for your efficiency ratios. So let's go to liquidity ratios. Yeah, I think there are like three. I'll have current ratio. And current ratio is simply
Current asset,
current asset
current
divided by what?
current liability.
Liabilities.
Liabilities.
And what does your current ratio measure? What does it measure?
And the number of times your assets can cover for your liability.
Okay. Instead of number of times, it could also be the ability of an entity to settle its current liabilities with its available current assets. And the general standard is 2:1. That at least your current assets should be at least two times your current liabilities. So from this statement of financial position, what's our current assets? Can you add the two together? Can you add these two? 5040 plus 1820.
6860.
Sorry?
6860 for 2023.
Okay. 6860. How about for 2022? Yeah, add the three together.
5960. 5960.
5960. Okay. Let's go and check our current liabilities. Okay. Our current liabilities is 1724 1512.
74, 512.
1724 15. Okay, so how much?
That's
4 to 1.
3.96 for 2023.
4:1.
3.96 ratio 1.
How about this?
It's still 4.4:1.
3.94 ratio 1.
Yeah, I just use that to 4.
4.
2.97.
What's the next liquidity ratio?
Acid test.
Or
Quick ratio.
and how do you compute it?
Current assets minus your inventory.
Divided by
Current
what?
Current liabilities.
liabilities.
Current assets is 6860. But our inventory is 5040. Yeah, current asset is 5960. Our inventory is 4720. And what's my current liabilities? 1724 1512. So how much are you looking at now?
1.0661.
Okay, how about this?
0.82. 0.82.
Okay. Any other liquidity ratio? Let's do cash ratio, which is cash and cash equivalents divided by the current liabilities. I mean, this one is looking at your ability to settle your liabilities with cash. With cash. So let's check our statement of financial position. Oh, this guy does not even have cash in 2023. He's in trouble. He doesn't have cash.
Liquidator, but
How about in 2022? He's 168. Yeah, again, it's going to be 0. Here is 168, Abi.
Yes, sir.
And the liability is how much? One five one two. So this is 0. This is how much?
One five one two.
1.12.
0.11.
Zero
Zero
point
point one. 0.11.
168 by 151.
Yes. Okay. Let's do solvency ratio. Here too, you can do 2 or 3 ratios. And the popular one is gearing or leverage ratio, which is your debt to equity ratio. You can do your debt over equity. 101. How much is your debt? It is your loan. You have 1648, you have 1616. You have 1648, you have 1616 over your equity.
5088.
5088. And what?
4640.
1.
4640. 4640.
So how much is that?
32%.
This?
35%.
So this company, I mean, if this ratio we got here is if it is over 100%, this company we will say is highly geared and is exposed to high financial risk. But 32% is very okay. 32% is very, very okay. Another one could be you can do proprietors ratio. It's very similar to this. This one is, while this one is looking at the proportion of debts and equity, this one is looking at proportion of equity to debt. What portion of your capital is equity? So it's just the reciprocal of that, which is equity over debt. And you see these ratios now, this one, for example, can be debt all over equity plus debt. While this one can be equity over debt plus equity, like that. So either way is just fine for you. So let's just reciprocate it. This is 1648. This is 1616. So how much is this?
309%.
Sorry?
309%.
Okay. How about this?
$287.
Okay. So these companies, the owners own majority shares when compared to equity, when compared to debt, they are far apart. 309%, 287%, which is good. So they are exposed to very little financial risk, as the case may be. Another one is interest cover. Interest cover, which looks at how many times your PBIT or your profits can pay your interests. How many times your profit can pay your interest? What was our profit in 2023?
Profit before
How much? Our profit before interest and
350.
tax.
That is profit before interest.
Yes, we computed it here. This
2332.
one. Okay.
Yes, 2332.
Okay. How about in 2022?
1364.
1364.
Yes.
Okay. What's
Yeah.
the interest paid?
Interest rate 172 and 136. 172 and 136.
Okay. So what's the interest cover ratio then?
Fourteen times.
How about this?
10 times.
Okay. So you have done three. You can do one more year if you want to. Let me just do one more for you. Let me do debt ratio for you. I know I've done four. I've done like 15 ratios. Who knows the formula for debt ratio? What is your debt? Your total assets times 100 over 1. So in 2022, my debt is 1648 1616. What's my total assets? What's total assets?
8460.
Okay, 8460. How about this one?
7768.
So what ratio? How many percent?
19%.
How about this one?
21%.
21%. So the reality is that all this one that we are doing, I don't know how you want to do it, but in the exam, you must be able to do it for around, let's say 15 minutes. You should be able to compute all of these ratios within 15 minutes. Because these 12 marks they are giving you in A part, what gives you the major part of the mark is not these ratios, is really the analysis. Okay, so I just intentionally went through it with you today just so that we can use it as revision to see how these ratios are computed and all of that. So I'll just stop here for tonight. So next week, I will do the analysis and all of that for this and the B and the C. And we are also going to look at the 2020, this 2024 November. We're also going to look at 2024 May, but that one, I will have computed the ratios for you. So I'll just teach you the analysis of that. But the analysis of this one, if you understand how to analyze this, you'll see that it's to analyze any other ratio, you'll find it easy. Just that beyond analysis, we need to relate it to the context given to us in the question. So all of that we're going to look at next week. So thank you very much. I'll see you guys next week. Yeah, but we're still going to have our class on Thursday for the makeup class that we do on Thursdays.
We've done the analysis, sir.